morning, everyone, and welcome to our DAT weekly market update. This is our update for May 2nd, 2023, if you can believe it. I'm Ken Adamo, Chief of Analytics over here at DAT, and I'm joined by Dean Croak, who is our Principal Industry Analyst. Good morning, Dean.
Good morning. How goes it, Ken?
You wouldn't believe it's May, given that there's accumulating wet, slushy snow here in the beautiful state of Ohio.
Yeah, it's snowing out here in Lake Tahoe today. It'll be another 5 inches. They had 700 inches of snow. That's 58 feet this winter. It's been one of the snowiest in 25 years, but the amount of damage it's done to infrastructure is substantial. Not to mention,
yeah, we had a great winter here. Very little snow. We've had a terrible, terrible spring. We went, like I mentioned before, 9 days without the sun. We're about to go 7 days without the sun. It's just been absolutely miserable. But what are you going to do? I'm rocking my Pork Chop Express t-shirt today, which is one of our engineering teams that works on the rating products. They had t-shirts made, and I just had to get myself one and rock it for the show. Just had to happen.
Looks good.
I don't actually know the reference. Do you?
Oh, I don't. I was just thinking of a truck company in Australia that had exactly the same name. They were always in the first
I imagine
line.
it's like a it's from Big Trouble in Little China, I believe.
That's it.
Yeah. Probably a truck that hauls hogs would be my guess, but I don't want to reach too far. All right. So for those less familiar, we're here every week at 10 a.m. Eastern, going through trends in the freight market. A lot of times we have a guest, but today it's just Dean and I, so you'll have to all struggle through just hearing us talk. But I'm going to get into our key points of the week so we can dive into the market update, if that sounds all right. All right. So spot rates are flattening out towards the end of the month. So we're seeing a little bit more volume. I think part of that's an end of the month blip. We'll get to that towards the end of the show. We've got some supplemental material to discuss. Interstate capacity continues to lead the industry. We did see a bit of a backslide after a couple months of recovery. I think you can pretty much blame that on the low spot rates and harsh conditions. Long-haul carrier profitability is getting down to 2019 levels. Again, no surprise given current state of the market and inflation. New orders from manufactured durable goods are up 3.5%. That excludes defense spending. And then Miami heats up, a little peek into the warmth. Peak shipping of flowers starts this week ahead of Mother's Day, along with higher Florida produce volumes up 13% year to date. With that, I'll turn it over to Dean to walk us through the market update. Dean?
We'll cover the Miami market. Things have been heating up substantially down there. A little bit of good news for carriers. But let's start off our weekly update with the dry van load to truck ratio. Shipping volumes are up. End of month volumes provided a much needed boost in the market. Volumes are up about 12% last week compared to the end of the first quarter. Last week's volumes were about 9% higher. Equipment posts up 4%. So the dry van load to truck ratio was up for the third week from 2.04 to 2.21. In the refrigerated market, load posts increased by 9% last week, but they continue to track at around half what they were a year ago. Of course, produce season is a big part of that. It's off to a much slower start. Volumes are about 14% lower year over year. And according to the USDA data that we've analysed yesterday, at the lowest level since 2016. Carrier equipment posts are around 7% higher than this time in 2019. And as a result, last week's load to truck ratio up slightly from 2.80 to 2.93. In flatbed, volumes are up 9% last week also. They were just over 2% lower than at the end of March and about 9% lower than this time in 2019. Carrier equipment posts up 5% last week, but also at the highest level in 7 years. Load to truck ratio up from 12.56 to 13.0. Having a couple of our markets around the country, we're starting off in the southeast. Produce season's impacting overall available capacity in dry van. At $1.61 a mile, regional rates are about up 5 cents a mile last week and at about the same levels as in 2017 and 2019 as a reference point. There were some solid gains reported for dry vans in Jacksonville. Spot rates jumped 11 cents a mile to an average outbound of $1.53. Volumes were up about 8% last week. At $1.20 a mile, loads 870 miles west to Houston were 10 cents a mile higher than in March, while regional loads south to Miami were at their lowest in 12 months at $2.17. In Atlanta, one of the largest markets in the southeast, spot rates increased for the third week to $1.64. Remember, folks, these exclude the fuel surcharge, so these are all in. Sorry, these aren't all in. These are line haul rates. $1.64. Georgia state level rates are about 10 cents a mile higher at $1.74, and also identical to this time in 2019. So that's at Georgia state level rates at $1.74, identical to 2019. Having a look on the West Coast, spot rates increased in California by 3 cents a mile for outbound loads, just 7 cents a mile higher than 2019. In Stockton, volumes are up 7%, spot rates up 6 cents a mile to $1.53, while in the most significant spot market in the state, in Los Angeles, spot market volumes are up 11% last week, rates up 2 cents a mile to $1.58. Having a quick look at some of the other big markets in Chicago, spot rates dropped for the fourth week to $1.85 a mile, even though volumes are up. Plenty of capacity there. One of the busier lanes, Chicago to Atlanta at $1.77 a mile, was the lowest in 12 months and 24 cents a mile lower than the March average. In the refrigerated market, capacity tightened considerably last week, also coincides with the annual 75 Chrome Shop truck show in Wildwood, Florida. Many reefer carriers take the week off, resulting in fewer available trucks to move loads north out of the states. Volumes are up about 19% in Lakeland, which is the biggest produce market in the state. Outbound reefer rates were up 12 cents a mile. On a high volume lane to Detroit, loads from Lakeland were paying $1.83 last week, which is almost 40 cents a mile higher than in March and 13 cents a mile higher than this time last year. State level Florida outbound rates at $2 a mile were almost identical to this time last year. Of course, Florida is benefiting a lot from the start of peak flower shipping ahead of Mother's Day. These 2 weeks, this week and a bit of last week and next week, will be very busy for flowers heading into the Mother's Day event. Having a look at the southern border in McAllen, reefer volumes are up 24% last week. Spot rates up 7 cents a mile to $2.20. Texas reefer rates averaging $2.10 a mile, are just 8 cents a mile lower than in 2018. McAllen to Oklahoma City retreated from last month's surge in spot rates, ending the previous week at $2.63. That's about 55 cents a mile lower than this time in March. Having a look at McAllen to Hunts Point in the Brooklyn market in New York City, rates were $2.19 a mile. That's 11 cents a mile lower than this time last month. And loads west to California, outbound reefer rates about 10 cents a mile lower than 2019. Having a look at the flatbed market, at $2.31 a mile, Texas flatbed line haul rates are almost identical to 2018. And even though volumes increased by 17% last week in Houston, that's the largest flatbed market in the country, rates dropped by a penny per mile for the third week. One of the busier lanes in flatbed is Houston to Fort Worth. Volumes are up 1% last week. Spot rates up to $2.96. That's the highest they've been since last October and 15 cents a mile higher than last month. Loads west to El Paso, very busy lane for flatbed carriers at $2.56, were the lowest in 12 months and about 87 cents a mile lower than this time last year. And in Little Rock, a market we haven't talked about for quite a few months, volumes are up 34% last week. Spot rates up 6 cents a mile to $2.54. Little Rock to Dallas, short haul regional lane at $3 a mile, were the highest since last August. Some pretty good rates out of St. Louis. Volumes are up 34%. Spot rates up 4 cents a mile to $2.25. And wrapping up our market update with our year-over-year look at spot rates, the multi-week slide in dry van rates was halted last week. Spot rates were flat, though, compared to the prior week. And whilst this could be the bottom of spot rates we've been waiting for, it could also be temporary following the end-of-month surge that we typically see from shippers. The national average last week, excluding fuel, was $1.62 per mile. That's about 10 cents a mile above 2019 levels. Based on the volume of loads moved, the average rate for our top 50 lanes was 23 cents a mile higher than the national average. It averaged $1.84 per mile last week for the top 50 lanes. In refrigerated, line haul rates were also flat last week at $1.90 and just 4 cents a mile higher than in 2019. Compared to this time last year, spot rates are about 56 cents a mile lower. In the flatbed market, national average was $2.16 a mile last week, excluding fuel. Rates have been around this level for most of the year. They're also about 50 cents a mile lower than this time last year, and trading about 18 cents a mile lower than in 2018 and about 18 cents a mile higher than in 2019, as you can see from the chart. So that's it for this week's market update. Remember, if you want to find out more about what's happening in freight, go to our market update. It'll be published this evening. Go to dat.com/market update, and our long form version of this week's update will be available. With that, it's over to Ken for the short-term forecast.
Thank you very much, Dean. So we're going to start like we always do with our dry van short-term forecast. This is a 35-day forecast, and we give a bit of history to give it context. So the blue line is the historical 7-day weighted moving average going back to, it looks like December 1st. It excludes fuel and it's long haul only. And you have 4 forecasting models. The green is RateCast, that's in all of our products. It's our flagship forecasting model. The red line is a short-term model, which more heavily weights predominant seasonality and short-term effects. And then you have blends of the two with the gray and the yellow lines. So what you're seeing here is optimism manifest in forecasting. So we've been saying this for a while, but if you look at when we pulled out of the tailspin in 18 and 16, it was actually the third week of May each year where that happened. It was the week of May 16th and 18th, respectively. I would submit that if we don't see at least one of these forecasting models come to fruition, with RateCast being the most conservative, we're in deep, for lack of a better term, to keep it PG on our corporate podcast here. We need to see seasonality exert itself to have any chance of a even disappointing year, to be quite honest. If we continue to blow through late May into June at current levels with no uptick, I think some of the more pessimistic fears will become realized as we get through summer and into fall. But again, the models are sensing that seasonality, albeit delayed. That's why you're seeing more of a sharp uptick with the short-term model. As we continue to see delayed seasonality, it's essentially going to be creating a steeper and steeper slope, trying to catch up with where the market kind of air quote should be. All right, let's go to reefer. You're going to see pretty much the exact same thing. So reefer is pretty much the exact same thing. I'm almost wondering if it's the exact same chart and we accidentally pasted it in twice. But the long and short of it is pretty much the exact same outlook, whether or not this is actually the correct chart or not. Let's move on to flatbed. So this one's a little bit more in alignment, if you will. So 3 of the 4 models are pretty much lockstep alignment with very little white space between them. And then you have RateCast, which is lagging behind a little bit conservatively. I think it's just not willing to be as overly optimistic as it could be. There's a lot underpinning this. We continue to see shockingly not disastrous housing data, just to put it that way. But when you look at the housing starts, it's not nearly as bad as it presumably could be given interest rates and inflation. But again, here you see modest upticks. There's not as much pronounced seasonality this time of year when you look at flatbed. It's more of a longer arc culminating late summer before things slow down heading into the winter. It'll be something to watch. But as it stands right now, definitely the bright spot amongst the 3, if you could say such a thing. But with that, that's our short-term forecast. Now let's bring Dean back for the question of the week.
Yeah, thanks, Ken. It looks like that chart, reefer chart, was my error, but it's almost identical. So you weren't too far off the mark. They're both picking up on the same sorts of seasonality. So question of the week kind of relates to that in a way. Have spot rates bottomed, or was last week just another end-of-month blip? We made a similar call, I think it was February, Ken, where spot rates jumped. Jumped is a relative term. They increased like 4 to 5 cents. I think it was in February, if memory serves me correctly, but then they started to fall away again. It was really just an end of season blip. But this week rates were flat. Normally at the end of month, we'd expect to see rates move up a little bit and capacity tighten slightly. The fact that rates were flat is, I guess, somewhat alarming, because normally we'd expect to see rates start to be rising a little bit towards the end of the month.
Yeah, let's hit the chart 1 here to kind of frame it up. I think we have 2, right, Dean?
Yep. We do.
So this is my favorite chart. It's debatable which one of these 2 is better, but this is year-over-year percent change. I would argue that both are important depending on what you're trying to study. But this is what's predicated: the coyote curve, the picket line, you name it. It's a really great way to look at year-over-year change. It keeps the data more stationary than the next chart we're presumably about to show. And what it shows is and the reason why it's important to look at both, I should take a step back, is because this shows the red line is year-over-year change in percent change in long-haul spot rates. The blue line is year-over-year percent change in contract rates. If you look just at this chart, you'd say, yay, spot rates are going up. Well, they're in fact not. They're just passing, as we've been talking about. much, much more favorable year-over-year comparables than in the past. So if you remember, rates are still falling this year, but last year they were like on a roller coaster. So this is maybe like the third or fourth hill on a roller coaster, right? You kind of taken a lot of the momentum out. Last year was the first big hill that we came down. So terrible analogy, but that's sort of how we sit here. But this would indicate that we're at or near some sort of bottom, right? Contract rates continue to fall. Once these two things, and specifically on this chart, intersect, that's when we get the most positive signals for a market cycle to start anew. Is that right, Dean? That kind of jive with what you're thinking?
Yeah, absolutely. Yeah, we've always been saying that some of the year-over-year comps would start to, skew our view of the market, but you're spot on.
All right, let's go to chart 2.
Yep.
I'm glad we led with the other one because it's my favorite. We should have probably, if we were being prudent analysts, led with this one. This is the absolute terms. So this is actual long haul dry van rate per mile, excluding fuel. So the red line, again, is spot. The blue line is contract. And this shows that contract rates are falling, and so are spot. That's the problem. They continue to fall. They're just, that big cliff we talked about is right kind of aligned with the last major tick mark on the x-axis. And there's a lot of space still between spot and contract, which means contract rates are going to continue to fall most likely until we see some material rebound in spot rates. Now, could seasonality provide a little bit of a false floor before the market catches up? Yeah, I mean, that's what we're all, I think, hoping to happen. But we need to keep in mind, we're going to keep saying on every show until it actually happens, two things need to happen. It could be either or both. Either we need to see a substantial influx in demand for trucking, which will happen with seasonality, right? But not kind of, no one's really expecting a macro influx of demand, and or a reduction in capacity, which we are seeing. So markets flip whenever you see one or both of those two things happening. So then it makes total sense, right? When you see more demand relative to the same or less amount of capacity, prices go up. When you see less demand relative to more or the same amount of capacity, rates go down. So that's really where we stand. We can probably peel this chart off and just split back to the two of us, but and we can make these available if you shoot us an email. We have this available for dry van, flat, and reefer. It's a really great monthly view. We only run it at the end of the month. It kind of keeps us from making foregone conclusions or something like that. But we're in a bit of a precarious position here, Dean.
Yeah, I was just looking at our capacity trends chart that we pulled from the FMCSA data this morning for interstate carriers. The sort of our sentiment index, which shows the spread between carriers coming into the industry and carriers leaving the industry. The net for April ended up being about 13,000 carriers left the industry and about 11,000 carriers either joined or reactivated. So the net was around a 2,000 carrier loss. Remember, that's interstate, not necessarily all of the intrastate carriers, but it's really a chart that looks at the long-term trend of carriers. The sentiment is, will I stay in the industry or will I leave? So we've been seeing carriers leaving the industry since last October. So that's certainly seeing capacity exit the industry for a variety of reasons. We're still seeing auction numbers pretty high for Class 8 sleeper trucks, especially with high mileage. So there's definitely another trend that's emerging, very similar to 2019 when we saw the number of trucks used trucks at auction spike in the second quarter of 2019. We're in the second quarter now and we're seeing similar sorts of numbers. So we still haven't seen a lot of positive indicators that capacity leaving the industry has slowed to a significant rate, although it has slowed down since the pretty significant exodus we saw in October, November. Carriers are sort of approaching that break-even level, Ken, where there's a tough decision to make, I think. Provided diesel keeps coming down, that'll provide some sort of a buffer. But as you said on the show last week, there's two things are going to happen. And just said again, of course, that it'll be more on the supply side, I think, that'll determine the next market cycle. We're still seeing carriers leave. We're not seeing a lot of strong seasonality just yet. So we're a few weeks away from knowing exactly what the demand side's going to look like.
Yeah, I mean, I think there's a couple things. One is that it's not pleasant to talk about the mechanics that need to happen for the market to to rectify, right? I mean, carrier, we talk about it as if it's kind of numbers on a page, but really it's carriers either going into different modalities or segments of the market or out of business altogether. So that's, I don't want to just make sure that we don't gloss over that. So there's some pain, unfortunately, left that has to exert itself in the market for it to flip. So I think that's kind of part one. I think part two really is, we're getting questions in the chat about when do we expect markets to normalize. If you're a shipper right now, you're continuing to most likely experience beneficial bid events, right? That will stop. That's when the market will invert, right? So there's like this absolute mechanic, and I think we talked about this in the show last week, where the reason contract lags spot is because contract rates are largely a forward-looking representation of market conditions when the bid was executed. So if you put an RFP out this week, conditions are very, very soft. You're likely to get a very, very good price in the market. It'll take a few months for the paperwork to get signed and the rates loaded up in your TMS, and that freight probably won't start moving for a month or 1 to 3 months. It's no surprise that contract rates tend to lag spot rates by 1 to 3 months, right? So, if you're on the shipper side, I would expect favorable RFP conditions for at least the next few months. And then once spot does start to rebound, probably it will continue to be favorable for the first 1 to 3 months in that rebound.
Right.
It doesn't mean you shouldn't prepare yourself, right? Go ahead.
Yeah, correct. Iname Ayub was able to provide us with some data on the contract rate trends this morning. So based on the last 2 weeks compared to the prior 2 weeks, so this would be the first half of April compared to the second half of April, dry van active rates. So this is the average of all of the rates that are currently in routing guides, was down 0.5%. Refrigerated down 0.5%, flatbed down 4%, which is a pretty big shift in the average. To your point, Ken, about RFPs negotiated in an earlier time frame, replacement rates are the new rates coming into routing guides. So dry van new rates coming in down 13% in the last 2 weeks. Refrigerated down 9%. Flatbed replacement rates were flat. And for those in the intermodal space, active rates in intermodal space are flat, but replacement rates are coming in at -5%. So that's the last 2 weeks compared to the first 2 weeks of April. So contract rates are still heading down based on current RFPs at a pretty significant clip. They've been running at about those numbers for the last 2 months on the replacement side.
Yeah. And so again, if you're a shipper, you need to be prepared for when the market swings back, right? It won't.
Right.
The good times won't last forever if you're a shipper. And I think if you're a carrier, it's the inverse advice. The bad times won't last forever. The market will go back up. And again, there's a lot of things looming, right? We were having a chat yesterday, and we're sitting on top of a potential major West Coast port disruption. There's still no, as far as I'm aware, I haven't kept totally on top of it. There's not been a contract resolution there on the West Coast. It seems like in UPS's latest earnings, they're preparing for potential labor disruptions with the Teamster contract that's coming due, I think, over the summer, right?
Yeah.
So if we have a busy tropical season and then some labor issues in one or both of those markets, it could be what, jumpstarts things, because that will throw demand. We talk about demand. It's not demand for overall trucking. I think this is one area where a lot of folks get wrapped around the axle. Total trucking volumes can stay relatively constant. And just a small shift between spot and contract can have really big impacts on the spot market. It's so much smaller. So if you're a spot carrier and there's some disruptions with West Coast labor or UPS or tropical weather that even throws 1 to 3% more of that contract volume going spot, that's enough to really kick us back into gear, to be quite honest.
Right. So, yeah. All right. So do you want to dive into a couple of questions, Ken? I think we answered the first one. Yeah, I think we answered the first one. When can we expect a normalization of freight rates? I think we've covered that a couple of times this morning. Andrew Webb asks, separately, having been able to review Q1 financial reports from the publicly traded trucking companies, what are your takes on the largest companies' strategies for approaching the current state of the market?
That's a great question.
Yeah, I mean, I could sort of give you some anecdotal evidence based on what they've been telling us during the last RFP. Of course, rates are coming down, as we just covered on the contract side. So carriers are, rebidding lower. Anecdotally, or I guess this has been supported by data on a number of fronts now from other shippers. shippers have been rewarding incumbent carriers with higher volumes in exchange for lower rates, and they've been more price disciplined was a theme that we heard during the RFP, certainly for most of this year and the last quarter of last year. Because of higher operating costs, carriers exercise much more discipline this time around. So I think carriers are coming off what was, if we follow the earnings calls for the last 5 quarters, terms like record revenue and income were thrown around fairly often. They're coming off a pretty strong 2022 is how a lot of market analysts are calling it. But the earnings will become tougher this year for sure. I think they're in pretty good shape based on the market last year and how much more profit they were able to make.
I mean, I think it really all depends. Like there are certain trucking companies that seem to take advantage of both markets, up and down. They're just well-run companies, right? Like, yep. Not to call anyone out, but Old Dominion Freight Lines is a company that generally does well in just about any market, right? They've diversified themselves. Mm-hmm. They're in expedited, they're in home moving, they're LTL. I think they do still LTL volume. They do volume, things like that. So, mm-hmm. And then there's ones that are just perennially poor. There's ones that are balanced more short haul versus long haul. There's ones that have a higher dependency on brokerage, right? So the issue that you run into with a lot of the huge trucking companies, right? And I do the air quotes because what do you consider a massive company that used to be exclusively trucking that now has a multi-billion-dollar brokerage, freight forwarding, intermodal? They're kind of exposed across the gamut. So I think their strategies are going to be a lot different than Heartland Express, for example, that are more primarily focused, or I don't even know if Pitt, Ohio or Dayton Freight. I don't think either of those are publicly traded, but kind of you get the gist of there's about as many trucking companies as there are different operating models. Are they Teamster or not? Are they union or not? But I think it's going to be really interesting. Everyone was running into a huge tailwind the last couple of years, right? You saw trucking companies posting, like even bad trucking companies were posting sub 90 operating ratios. That's not going to be the norm. Mm-hmm. But companies that historically ran really good ORs will probably continue to run really good ORs. Keep in mind, a lot of these big trucking companies anyway are balanced heavily on the contract side. So there's still, contract rates are still pretty good. I mean, they're not like what they were, but they're still excellent. Now, the question becomes, go ahead, Dean.
Well, I was just going to say they've been also, because on top of being more price disciplined, they've been talking to their shippers about the acceleration of the next market cycle with messaging, such as when the market turns, there'll be far less trucks in the market. So I think shippers have also been aware of the fact that we're coming off a pretty big capacity crunch in the last couple of years. They have better memories than most when it comes to the impact of less capacity. So I think there's been a much more healthy discussion between shippers and carriers this time around where rates need to be as we head into the next cycle, because it's evident that the next cycle is around the corner, and shippers have been very concerned about making sure they've got capacity in place during what's typically the busier time of the year through the summer and the third and fourth quarters.
Yeah, I mean, again, it'll all really be determined on exactly where we cross over and when we cross over. I think it'll be pretty much bad across the board. If the market sentiment is so negative that it outweighs the dominant seasonality that we're approaching, again, I think we have to refocus our analysis and our perspective, to be quite honest with you. I mean, just to put that out in terms, and you can cut this out as a hot take clip, we'll be wrong. We'll be very, 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 very wrong. But again, we'll have to adapt. It's just the way this market is. No one has a crystal ball. But again, I expect if we were able to pull out of 19 and more specifically pull out of the 15-16 tailspin, I have a feeling that we'll be able to at least capture some seasonality. But the problem is, before we move on to the next or last question, is we saw the dominant peak retail shipping seasonality at the end of last year carrying into the first couple of weeks of January. But that was quickly erased. That's what we got to kind of be mindful of, right? So this could be the question is, like, if you assume, let's just put the edge case on a shelf, which is the edge case being we just completely stay flat or down. Let's say we do experience mid-May to July 4 seasonality. Question becomes, how much of that, if any, do we hold on to? Or do we spend most of July just backsliding back to current levels? because there's a long period then between the next seasonal bump. And unfortunately, that's pretty much exactly what happened in 19, right? It's just stayed on the floor.
Yep.
So that's essentially the optionality we're looking at.
Mahalo asks, what type of equipment has actually fared the worst in the last 2 years? It's an interesting question, Ken. I've been thinking about it. My sense is that refrigerated carriers have fared the worst, largely because of last year's non-existent produce season on the West Coast and an oversupply in that section of the market. So that's sort of when everybody has had a pretty tough go of it in the last year. But refrigerated carriers seem to have had a much tougher time. That's sort of my short hot take there.
You're starting to see it, right? I mean, again, we look at the data, but we kind of poke our head out of the ostrich hole from time to time as well, and Dean more than anyone else. But you're starting to see on LinkedIn a lot of the influencer drivers posting pictures, loading up with all of their produce. So Al Roker this morning on the Today Show said we should expect 1 month longer of a growing season in Southern California and through most of the Southeast as well this year, just given current weather patterns. So late start, longer finish, that could be really good. So I think it's not all doom and gloom. It's certainly gloom. I don't know how much doom has entered the picture yet.
Last question, Ken, from Teflon Ron. What a great handle.
Love that name.
Yeah, that's awesome. What's the average rate for reefer loads per mile? As we had on the chart a little bit earlier, Ron, the excluding fuel, it was $1.90 per mile. If I look at the national rates quickly in RateView right now, we're at, if I exclude fuel, so all-in rates are about $2.39. Sorry, that's reefer rates, about $2.39, excluding fuel at about $1.90 per mile, which is, to answer the previous question, I think that's about 56 cents a mile lower than this time last year. It's of all the year-over-year comps, reefer has the widest gap compared to week 17 of 2022.
Yeah, I mean, it's getting hairy, right? I mean, there's no kind of two ways around it.
Yeah, absolutely.
All right, anything else?
Right. Yes, got some few shout-outs. That's all the questions, so we'll quickly wrap up the show. Sales Chatter Day-to-Day Wednesdays on tomorrow. I'll be on with Ryan Muhammad and Dan Deegan, 11 a.m. Eastern, Day-to-Day Wednesday. We're on Landline now tomorrow night, 7 p.m. Eastern on Sirius XM Road Dog Radio Channel 146. Freightvine out this week has Mark Levinson, container and global supply chain author of several influential books. He's talking to Professor Kaplis about how globalization is now entering a new era in moving physical goods. The shipper supply chain team from DAT will be at the Gartner Supply Chain Expo in Orlando, May 8 to 10. Professor Kaplis will be speaking on the revolution in transportation procurement. Remember, RoadCheck Week is just 2 weeks away. Focus is on ABS and cargo securement. And lastly, don't forget that my blog post will be up this evening where we break down a lot of the operating costs and look at the chart that I've been able to produce on owner-operator viability over the last 4 years. And it's a really interesting comparison of 2019 to the current situation this year. With that, it's back to Ken to wrap up the show.
All right. Thank you, Dean. It's been a really good show this week. It was good for just Dean and I to geek out on the data. If you have any questions or follow-up or want that chart or other charts, you know how to reach us. It's askiq@dat.com. We're happy to engage there or on LinkedIn or any of the other social channels. We will be back next week at 10 a.m. Eastern. We hope to see you there. We hope you have a great and safe week, and we will talk to you later. Goodbye, everyone.
Okay. Bye-bye.